Every country on Earth is drowning in debt. The United States government owes over $34 trillion. The European Union owes nearly $15 trillion. Japan owes over $9 trillion. Combined, global government debt now exceeds $97 trillion. It's a staggering figure that has quadrupled since the year 2000. It's a number so large it feels meaningless, an avalanche of red ink threatening to bury the entire world economy. When we hear these figures, a simple, nagging question comes to mind. If every country owes money, who are they borrowing it from? Who is the world's creditor? Watch till the end to find out the shocking truth. The answer is far stranger and more profound than you might think. It reveals a hidden architecture of modern finance, a system where debt isn't just a liability to be repaid, but the very foundation of money itself. The truth is, there is no single entity, no shadowy cabal of intergalactic bankers holding the world's IOUs. Instead, the creditor is a complex web of promises we have all made to each other, a system built not on repayment, but on perpetual confidence. In this video, we'll dismantle the myth of national debt and reveal how modern economies turned an endless cycle of borrowing into the engine of global prosperity. To understand how this system works, we first need to rethink what government debt actually is. Instead, it issues financial instruments called sovereign bonds. These bonds are essentially IOUs, promises from the government to pay back the borrowed amount, known as the principal, at a specified future date, along with regular interest payments in the meantime. So, who buys these bonds? The answer is not some other country or a handful of billionaires. The single largest owner of U.S. government debt is the U.S. government itself. Social Security, Medicare, and various other government trust funds are required by law to invest their surpluses in Treasury bonds. This is an internal accounting mechanism. One part of the government is lending money to another. The second largest holder is the U.S. Federal Reserve, America's central bank. Together, these governmental entities hold a massive portion of the national debt. But the biggest slice of the pie is owned by individuals and institutions, both domestic and foreign. This includes American citizens who own savings bonds, pension funds managing retirement money for millions of workers, insurance companies, and mutual funds that many people have in their 401ks. In fact, the vast majority of America's debt is owned by Americans themselves in one form or another. It's part of the national savings. Foreign countries like Japan and China also hold significant amounts, but they are far from being the majority creditors. They buy U.S. bonds not to control America, but because these bonds are considered the safest financial asset in the world, a stable place to park their vast reserves of U.S. dollars. This brings us to the most counterintuitive part of the whole system. Governments have absolutely no intention of ever paying off their total debt. Not now, not ever. This sounds fiscally irresponsible, even insane. If you took out a mortgage and told the bank you only plan to pay the interest forever, you'd be laughed out of the building. But for a sovereign nation that can issue its own currency, the rules are fundamentally different. The goal isn't to eliminate the debt, it's to manage it. When a government bond matures and the principal is due, the government doesn't scramble to find the cash to pay it back. Instead, it simply issues new bonds to raise the money needed to pay off the old ones. This process is called rolling over the debt. As long as there are willing buyers for the new bonds, this can continue indefinitely. The only real cost the government has to worry about on a day-to-day basis is making the interest payments. The real measure of a country's debt health isn't the total dollar amount, but its ability to service that interest relative to the size of its economy, its GDP. Imagine the national debt not as a credit card bill that must be paid down to zero, but as a perpetual mortgage on a property that is constantly increasing in value, the property being the entire national economy. As long as the economy grows faster than the interest payments on the debt, the burden remains manageable. The system only breaks down if investors lose confidence and stop buying new bonds, or demand such high interest rates that the payments become unsustainable. This is why a country's creditworthiness and the stability of its government are paramount. The entire edifice is built on the belief that the government will always be there to honor its promises. So, where do central banks fit into this picture? Institutions like the U.S. Federal Reserve, the European Central Bank, and the Bank of Japan play a crucial, often misunderstood, role. They are the ultimate backstop for the system. When financial markets are in turmoil, or when there aren't enough private buyers for government bonds, the central bank can step in and buy them itself. But where does the central bank get the money to buy these bonds? It creates it, electronically, out of thin air. This process, known as quantitative easing, QE, involves the central bank adding digital currency to its own balance sheet and using it to purchase government bonds from commercial banks. This action does two things simultaneously. First, it injects new money into the financial system, which the commercial banks can then lend out to businesses and individuals, stimulating the economy. Second, it creates artificial demand for government bonds, which keeps their prices high and interest rates low, making it cheaper for the government to continue borrowing and rolling over its debt. In essence, the central bank is manufacturing debt to create money. When the Fed buys a U.S. Treasury bond, it is swapping one type of government liability, the bond, for another, currency or central bank reserves. This reveals the deepest truth of modern finance. Sovereign bonds and money are two sides of the same coin. Bonds are just a form of money that pays interest, and money is just a form of government debt that pays no interest. They are both promises, fundamentally backed by the same thing, the full faith and credit of the government. This is how the system sustains itself. Governments issue debt to fund their operations. That debt is then purchased by individuals, corporations, and other governments, turning it into the world's primary safe asset and savings vehicle. And when needed, the central bank can create new money to buy that debt, ensuring the cycle continues. The creditor isn't a person or a country, it's the system itself. It's a vast, interlocking network of promises where pension funds, insurance companies, foreign nations, and everyday citizens all agree to lend money to the government in exchange for a secure return. The government, in turn, uses its power to tax and print money to guarantee those promises. So, if the system is designed to run on endless debt, should we stop worrying about deficits and trillion-dollar figures? Not exactly. While the total amount of debt may not be the ticking time bomb it's often made out to be, it's not without consequences. The constant creation of money to finance debt can lead to inflation, devaluing the savings of ordinary people. High debt levels can also make a country vulnerable to shocks. If confidence were to suddenly evaporate, it could trigger a sovereign debt crisis, where the government can no longer roll over its debt at affordable rates. This can lead to brutal austerity measures, economic collapse, and social unrest, as seen in countries like Greece over the past decade. The system works, but it's a delicate balancing act. It depends entirely on trust, the unwavering belief that the promises will be kept, that the currency will hold its value, and that the economy will continue to grow. The true creditor, in the end, is not an external entity we owe money to. The creditor is our collective future. We are borrowing from the prosperity of tomorrow to pay for the needs of today. As long as tomorrow is expected to be more prosperous than today, the system holds. But if that fundamental belief ever falters, the entire global financial machine could grind to a halt. Once you understand that the global debt system is not about repayment, but about refinancing, and that money itself is a form of government debt, you begin to see the world differently. You realize that the headlines about national debt are often telling the wrong story. They focus on the alarming size of the liability, but they miss the more important questions. Who owns the asset? What is it being used for? And most importantly, do we still have confidence in the promise? Because in the strange circular logic of modern economies, that confidence is the only thing that truly holds it all together. The creditor is us, and the debt is the promise we make to ourselves. If you like this video, subscribe to this channel for more financial mysteries around the world.